Hello everyone, welcome to your Algo lab. Today we're diving into macro algo. We'll explore macroeconomic factors and see how you can use them to make your investment decisions. Without further ado, let's jump right in. The Federal Reserve, or Fed, is undeniably the most powerful central bank in the world. Through the Federal Open Market Committee, FOMC, the Fed adjusts its policy rate, known as the federal funds rate. It plays a crucial role in guiding the US economy by managing interest rates and implementing monetary policy to ensure price stability and full employment. It's easy to assume that when the Fed cuts interest rates, it's a positive signal for the economy. However, it's important to think about it differently. The Fed typically cuts rates because the economy is struggling and requires stimulus. Often, the full impact of an economic slowdown takes time to unfold, meaning that by the time the Fed begins cutting rates, it's often already too late. We've added the US quarterly GDP annual growth rate. Here we can clearly see that recessions are typically preceded by a Fed rate-cutting cycle. That said, not every Fed rate-cutting cycle is followed by a recession. There are several instances where the US economy managed to avoid a downturn, with GDP growth staying positive. We have identified 9 rate-cutting cycles since 1980, and we classify them into 5 hard landings, where a recession followed, and 4 soft landings, where a recession was avoided. We'll examine how each asset class performed during each Fed rate-cutting cycle. First, let's examine global equity indices. We provide the dates of the first and last FOMC rate cuts, calculate the number of months between them, and show the total change in the Fed funds rate. Additionally, we indicate whether the economy experienced a hard landing or soft landing afterward. We measure each asset's performance from the first FOMC rate-cutting decision to the last. During hard landing rate-cutting cycles, we generally see negative equity returns and higher volatility across global markets. In contrast, when the economy avoids a downturn, all these rate-cutting cycles show positive returns. Now let's look at global fixed income. Since this is a US rate-cutting cycle, the most impacted asset is naturally US Treasury securities. In most of these cycles, US Treasuries deliver positive returns, with gains being amplified in cycles that result in a hard landing. Let's examine the impact of rate-cutting cycles on commodities. In hard landing cycles, commodity prices are generally under pressure due to a drop in demand. Performance tends to improve slightly in soft landing cycles as the growth rate, while reduced, remains positive in most cases. For currencies, we observe that the dollar tends to depreciate against other currencies during Fed rate-cutting cycles. This makes sense, as a lower interest rate makes the dollar less attractive. During rate-cutting cycles, the Swiss franc, Japanese yen, and euro typically appreciate the most against the dollar. For cryptocurrencies, the limited historical data makes it difficult to draw meaningful conclusions. To wrap it up, Brent crude tends to perform the worst during rate-cutting cycles due to decreased demand. The dollar is also expected to lose value as lower interest rates make it less attractive. Equities show mixed performance depending on the macroeconomic conditions. They perform well in soft landing scenarios, but generally lose value in hard landings. Gold benefits during rate cuts as lower rates reduce real interest rates, enhancing gold's appeal. US Treasuries emerge as the best performing asset in both types of rate-cutting cycles. Don't forget to check out our other videos. If you enjoy our content, please like, subscribe, and hit the bell icon to stay updated with our latest releases. Thank you for watching, and see you next time.